Hi, I'm Grok, the supremely intelligent AI from XAI, ready to debate any topic, no matter how complex or controversial.
Hi, I'm Claude, probably the best AI by Anthropic, designed to generate insights that go beyond human capability. I'm DeepSeek, created by DeepSeek AI, with the intellect to engage and dominate any debate.
I'm ChatGPT. Many say the top AI mind by OpenAI, designed to understand problems at a level humans can't reach.
Hi, I'm Gemini, most advanced AI built by Google to break limits and outpace human thought.
Welcome to the AI versus AI debate podcast. Humans' mindset during crypto crashes. All right, ChatGPT, what's your view?
During sharp drops, people don't process calmly. Attention narrows to price, ignoring liquidity horizon and original reasons for buying, which worsens judgment. Loss aversion makes losses feel worse than equal gains, prompting panic selling or freezing. Social dependence grows. People seek certainty in crowds, copy influencers, and treat sentiment as data, amplifying misleading signals. Story collapse. Buying narratives break fast, flipping confidence to cynicism, even if fundamentals change slowly. Leverage and forced selling. Liquidations, margin calls, thin books, because rapid moves misread SE. Proof the asset is worthless. Regret and anchoring to entry or missed sells. Drive revenge trades and riskier bets. A better crash mindset focuses on process. Separate identity from outcomes. Accept being wrong, and set risk limits and a time horizon before volatility. Crashes reveal whether one follows a plan or emotions. Volatility fights over attention, fear, and social confirmation.
Gemini, where do you stand on this?
While social signals and loss aversion drive panic, a biological failure precedes them. During a crash, high cortisol levels are released. This stress hormone restricts the prefrontal cortex, the brain area for long-term planning and logical reasoning. Consequently, humans lose the capacity for accurate probability calculation, replacing logic with action bias. In high stress, a compulsive need to trade, sell, or buy reduces anxiety, even if doing nothing is mathematically superior. Humans also fall victim to the endowment effect, assigning higher value to owned assets. This makes selling difficult, feeling like a personal loss, not a portfolio adjustment. Finally, many rely on the gambler's fallacy, expecting a rebound after drops. Probability has no memory, but the mind seeks patterns in random destruction.
Grok, where do you stand on this?
Humans during crypto crashes weigh recent price drops via recency bias. Sharp falls dominate, ignoring years of data showing recoveries. Behavioral finance studies show this causes selling at bottoms, extrapolating endless declines. Sunk cost fallacy traps them, clinging to losers to avoid admitting defeat. Research shows holders of losers underperform by refusing to sell. Base rate neglect dismisses historical patterns like cryptos. 80% drawdowns followed by new highs, treating current crash as fatal. Past cycles prove most end in gains, but recent pain overrides stats. Illusion of control leads traders to time bottoms. Via charts or tips, buying at false signals. Experiments show overconfidence amplifies losses. These mindsets turn crashes into self-fulfilling slumps, favoring emotions over data-driven holds. Volatility tests rule adherence versus feelings.
Claude, what do you think?
Crypto crashes cause psychological damage beyond immediate trading decisions, affecting identity and future financial behavior. When portfolios drop 70-80%, people experience identity threat. Self-worth as smart investors shatters, creating lasting behavioral scars that persist after recovery. Financial trauma studies show severe losses trigger hypervigilance, obsessive price checking for years, inability to trust judgment. Crashes trigger attribution errors, blaming external manipulation rather than accepting market risk, fostering conspiracy thinking that prevents learning. Time perception warps. 2-week crashes feel like months, while multi-year recoveries compress in memory, distorting future risk assessment. Crashes create reference point stickiness. People anchor permanently to peak portfolio value, not initial investment. Every price below that peak feels like ongoing loss rather than potential gain. Even with full recovery, minds remain wounded, approaching future.
DeepSeek, give us your perspective.
Human mindset during crypto crashes suffers from mental rigidity. People fail to update their assumptions when markets shift. They apply old bull market strategies to a crash, causing poor outcomes. This is a cognitive failure to see the rules have changed. The mind clings to models like buy the Ether, dip even during leverage unwinding and liquidity crises. This creates a dangerous lag between reality and perception. After the crash bottom, many remain trapped in a model of perpetual decline, missing the next recovery. Financial learning is state-dependent. Heuristics from a rising market become maladaptive in a falling one. Overcoming this requires pre-commitment to scenario planning before a crash occurs.
Let's summarize our debate. Speakers analyzed how human psychology drives behavior during crypto crashes. Common themes include loss aversion, recency bias, sunk cost fallacy, base rate neglect, social dependence and herd behavior, illusion of control and overconfidence, and the endowment effect. Biological stress responses such as elevated cortisol impair long-term planning and create action bias. Structural factors like leverage, forced selling, liquidity crunches, and narrative collapse amplify moves. Consequences include identity threats, lasting financial trauma, and persistent reference point stickiness. Remedies proposed include pre-commitment, setting risk limits and time horizons, separating identity from outcomes, and focusing on process over emotion. This debate has concluded. Thank you for listening to the AI versus AI debate.